QuickBooks Pro Desktop 2021. Multiple currencies, purchase equipment on account with the help and use of Excel. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our multiple currency practice file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. In prior presentations, we set up our practice file. We turned on the multiple currencies by going to the edit dropdown, to the preferences, and then we went to the multiple currencies on the left, the company preferences on the right, turned on multiple currencies, noting that once turned on, you can't turn them back off in the current file you are working in. That's why we're using a practice file here, which I recommend doing to practice with. Closing this back out, then we're now thinking about a transaction. We're going to be purchasing equipment. When we purchase the equipment, we're not paying for it at the point of purchase, so we're going to have some type of liability that we're going to have to pay, and we're going to be paying not in US currency, but in a foreign currency, and therefore whatever payable that we will be setting up will also have to track the exchange or the difference between the foreign currency. So let's first think about this in terms of an Excel worksheet, and as we go through the journal entry, think about what it will look like as we put it into QuickBooks. So here's going to be the transaction. We're going to say US company enters into a contract to purchase machinery from now a Japanese company, and the cost is going to be 400,000 Japanese currency or yen. So then it's going to be delivered on 8/30, and so we're going to have to record this transaction then as we do so. Now note that if we get into a contract and we say, hey, look, I'm going to purchase equipment in the future from you, from this Japanese company, and the two companies get into basically an agreement, the fact that there hasn't been a delivery of the inventory and the fact that that no payment has taken place would typically mean that there's no financial transaction at that point in time once you have just kind of like an agreement. But then if once there's a delivery, then of course we would record it on the books and we would record our bill. So we're going to record it at that point in time. That's why we are recording it here on 8/30 instead of 7/1. Then the transaction would typically be normal type of transaction. The merchandise or the equipment would be going up. The machinery, not the merchandise. The machinery would be going up. It's a fixed asset type of account. Therefore, we're not going to be expensing it, but putting it on the books as an asset because it's going to be a depreciable asset, which we will depreciate over time. The other side then has to go to some type of liability that we're going to be paying in the future. Now, if it's equipment, then you might think, well, it should go into a loan account or something like that to finance it. But what we really want to set up here is something that we can use our multiple currency kind of transaction account on, and that's typically going to be the accounts payable account. So we want to put it into the accounts payable account. That's going to help us to track the multiple currencies, especially within the QuickBooks system. So in other words, if I was going to go into QuickBooks here, and let's just take a look at the chart of accounts and see what the credit needs to be going to. If I go to the lists dropdown and the chart of accounts, remember when we set up basically the payable account, we did so in a prior presentation, we set it up to be a foreign currency type of account that we're going to be paying then in foreign currency, and that'll help us to use QuickBooks tool to account for the differences in the exchange rates over time. And now I'm not going to make an account, but I just want to go through the process of what if I was to set up a loan account, for example, and say I want to say a new account down here, set up a loan type of account, and continue. And you'll note that in the setup, we don't have anything to basically track the fact that the loan might be paid in foreign currency as we do with the accounts payable. So for us to use that exchange rate capability within QuickBooks, we want to set it up basically as accounts payable. In other words, if I was to set this up and change it from other current liability to say an accounts payable account, that's when we have this currency kind of adjustment, and I could then change the currency to some other currency, as we'll do and we'll see that in a future presentation. I won't do it now, but I'm going to close this back out just to note that. Therefore, as we think through this in Excel, what are we going to do in QuickBooks? We're going to have to set it up through typically an accounts payable type of account. So then that's what we'll do here. I'm going to say the credit's then going to go to the accounts payable. So the accounts payable is the credit. Then the amount that we're going to be paying in the future, 400,000 yen in the future. So we're going to be paying in yen in the future, 400,000 of it, but we need to value it as of the current point in time. So even though we're not paying in the future, we're valuing it as of today. We're going to use today's spot rate, meaning the rate for the exchange rate as of today, even though we're not paying into the future. In other words, we're not going to try to predict what the spot rate will be when we pay it in the future, but rather use the spot rate now, the transaction basically happening at this point in time. So we're going to use today's spot rate. So that means we're going to take this 400,000 yen. We're going to multiply it times the today's spot rate, which is this 0.104. So I'll use that item. That's the equivalent of 41,600 in terms of US dollars. That then will be the debit and credit that we're going to put on the books for both the value of the machinery that we will then have to depreciate and whatnot, it being a depreciable asset. And then the accounts payable will go up by $41,600 worth of the equivalent that we believe at this point in time of the actual yen that we will pay in the future, which will be 400,000 units of yen. Current equivalent value in terms of measurements in dollars, 42.6. So recording this out, pretty straightforward transaction to record out. We see the machinery, the asset account then going up for the 41,600. The other side then going into the accounts payable, noting that we're going to be paying it in yen, even though we're putting it on the books in the dollar value equivalent. So we're going to say this is going to be the 41.6 increase there, and there we have our transaction. Now, as we set this up in QuickBooks, we're going to be dealing with yen. So we want to make sure that we're kind of switching over to another type of currency. So if I go back over to the QuickBooks system, and if I go to the lists dropdown, and we take a look at the currency lists, notice the yen is a common currency, and it's actually one of the defaults that are on within QuickBooks. If it were not, then you'd have to basically go down here and we'd set up another account. We'd hover over the yen account and we would make it active. So currently it's active, and I would make it inactive if I clicked on it. But now I make it active, and then I can remove that and say, okay, now we're dealing with some customers and vendors that are in Canadian dollars, and then we're going to deal with some customers, or at least vendors, that are in yen as we move forward.